The S&P 500 has long been a benchmark for U.S. equities, representing the performance of the 500 largest publicly traded companies. However, despite its historical resilience, there are several factors in 2025 that could signal trouble for this widely followed index. Whether it's macroeconomic pressures, shifting market dynamics, or geopolitical uncertainty, investors should be aware of the risks that could contribute to a significant drop in the S&P 500. In this video, we'll discuss the top 10 reasons the S&P 500 might face a major downturn in 2025. 1. Rising interest rates. The Federal Reserve has been raising interest rates in an effort to combat inflation. While higher interest rates can help stabilize prices, they can also make borrowing more expensive, which could hurt consumer spending and corporate profits. The resulting slowdown in economic growth could lead to a decline in stock valuations, particularly in the interest-sensitive sectors like real estate, utilities, and technology. If the Fed continues its tightening cycle in 2025, the S&P 500 could feel the pressure. 2. Ongoing inflation concerns. Despite efforts to control inflation, it remains a significant issue in 2025. Persistent inflation can erode purchasing power and lead to higher operational costs for companies. If inflation continues to outpace wage growth, consumers may reduce spending, which would negatively impact corporate earnings and stock prices. As inflation remains high, investors may reassess the future growth prospects of the companies in the S&P 500, leading to a market correction. 3. Geopolitical tensions and global instability. Geopolitical instability, particularly in regions like Eastern Europe, the Middle East, and parts of Asia, could severely impact global markets. Tensions between major economies, such as the US and China, could lead to trade disruptions, sanctions, or even military conflicts. The risk of geopolitical conflict often leads to market volatility as investors react to potential disruptions in trade and energy supplies. Geopolitical crises can cause significant market downturns, especially if they lead to higher energy prices or supply chain disruptions. 4. Corporate earnings miss expectations. The S&P 500's performance is heavily influenced by the earnings of its constituent companies. If companies fail to meet analysts' expectations for revenue and profit growth, the overall market sentiment could turn negative. Weak earnings reports, particularly from major market leaders in sectors like technology and finance, could prompt a broad sell-off. If corporate profits stagnate or decline due to higher costs or weaker demand, it could trigger a market correction. 5. Slowdown in consumer spending. The U.S. economy is heavily dependent on consumer spending, which represents nearly 70% of GDP. If consumers become more cautious in their spending due to economic uncertainty, higher living costs, or reduced disposable income, this could lead to weaker demand for goods and services. Companies that rely on consumer spending may face significant revenue declines, which could lead to lower stock prices, particularly in the retail, travel, and entertainment sectors. 6. The end of the bull market. The current bull market has been running for over a decade, making it one of the longest in history. While bull markets are typically characterized by rising stock prices, they don't last forever. If the market has been in an extended uptrend, it could be due for a natural correction. A market top could be forming, and as investors begin to realize that stock prices have become inflated, a major sell-off may occur. This could be triggered by a combination of factors, including high valuations and changing market sentiment. 7. Supply chain disruptions. Despite improvements in supply chains since the COVID-19 pandemic, global supply chain issues remain a concern. Disruptions due to natural disasters, pandemics, or geopolitical conflicts could lead to product shortages, delays, and higher production costs. These disruptions would particularly affect manufacturers and retailers in the S&P 500. If major companies in the index face supply chain problems, their stock prices could suffer, dragging down the overall market. 8. Tightening of liquidity in the financial system. The Federal Reserve's policies, particularly its quantitative tightening measures, are aimed at reducing the money supply in the economy. While this is done to combat inflation, it could also reduce the amount of liquidity available for investment in stocks. If liquidity tightens too much, it may lead to higher borrowing costs and decreased investment in riskier assets like stocks. The lack of liquidity could cause a sharp sell-off, especially in the more speculative sectors like technology and startups. 9. Overvaluation of growth stocks. In recent years, growth stocks, particularly in the technology sector, have become significantly overvalued. While these companies have strong growth prospects, their stock prices have been driven to unsustainable levels based on future expectations. If investor sentiment shifts and people begin to realize that the high multiples assigned to growth stocks are unjustified, it could trigger a correction in the tech-heavy portion of the S&P 500. This could have a broad impact on the index, as technology stocks make up a large portion of its market capitalization. 10. Risk of a recession. One of the biggest risks facing the S&P 500 in 2025 is the possibility of a recession. While the economy may currently show signs of strength, many factors could lead to a slowdown, including high inflation, rising interest rates, and an eventual reduction in consumer and business confidence. A recession could lead to negative growth in corporate earnings, reduced consumer demand, and widespread job losses, all of which could pull down stock prices across the S&P 500. The S&P 500 is a resilient index, but there are a variety of factors in 2025 that could pose significant risks to its performance. From rising interest rates and geopolitical instability to corporate earnings misses and the overvaluation of growth stocks, these risks could lead to a sharp market correction. While predicting the timing and extent of a drop is difficult, investors must remain cautious and monitor these factors closely as they could impact the broader stock market and investor sentiment.